I tell my community all the time, if it is taking more money from your pocket than it is leaving in your pocket, you're not growing and you're not building wealth. If the average interest rate on all your debts is greater than the return on investment on your investments, you're not building wealth. Your net worth is equal to your assets, which is the stocks you have, the cash you have at bank, in your savings account, the properties you own, minus your liabilities, which is all the debt you owe. So your credit card debts, your lines of credit, your car loans, even your mortgage loan. Which means if you really want your net worth to grow, you need to focus on paying down your liabilities or grow your assets. But pay down your liabilities so that your assets can grow without feeling the pullback from your liabilities. One of the ways you can pay down your liabilities faster is to reduce the interest portion of your liabilities. The lower the interest, the faster you pay down your liabilities. The faster you pay down your liabilities, the faster your net worth grows. And that's what we're all looking for. Growth in our net worth equals to growth in our wealth. Growth in wealth equals to financial freedom. Hello everyone, and welcome again to Growing with Nelson. My name is Nelson, and here I talk about personal finance, investing, growing and building your wealth, savings, and budgeting. Literally everything you need to know to become a better person. In this video, we'll be discussing what a balance transfer is, how it works, what you need to do to qualify, the strategy, is it a good one, is it a bad one, and the concerns that you may have in accepting and using this product. So let's dive in. So what is a balance transfer? It is simply what the name says, balance transfer. A balance transfer is when you transfer your debt, usually from a high interest credit card to a new card that has a lower interest rate or a 0% interest rate on it. How does it work? 1. You can apply for a balance transfer card, or for most people that have good credit score, you may have already gotten pre-approved for a balance transfer card. So in order for you to apply, usually you need to have a good credit score. You need to have a good transactional relationship with the bank for the bank to offer you that product called balance transfer. Because let's face it, interest is a profit to the bank. So if they offer you a product that gives you 0 interest rate, they are certainly getting nothing from you for the period that the promotion lasts, 6 months, 10 months, or 12 months. So they can only offer those that qualify. And in order for you to qualify, you need to have a good credit score and a good transactional relationship with the bank. Step 2. Once you're approved, you can transfer the existing debt you have on other banks' credit cards to the new credit card that the bank has offered you called the balance transfer credit card, where you have the 0% interest rate, or for some cases, very low interest rate. But I've seen more cases offering 0% interest rate, and that's the one you should be targeting, and you can negotiate with your bank for this. During the introductory 0% interest period, you pay absolutely no interest, and that's very fantastic, guys. You pay no interest, giving you the ability to keep more money in your wallet or use that money to pay down the principal balance of that credit card. The catch here is that you need to make your minimum payments, right? You need to constantly make your minimum payments. And you should also know this, when the promotional period ends, so if they give you a balance transfer card for 12 months, when the 12 month ends, the card reverts back to the high interest rate card that it was in the first place. Now, let's talk about the strategy. Is it a good strategy? The simple answer is yes. Yes, it is a good strategy. Who doesn't want 0 interest? That's like free money, right? For a period of time at least, right? So if you have it for 6 months or 10 months or 12 months or 18 months, it is 0 interest rate for that period of time. And that's free money, and that's a good strategy. But why is it a good strategy? If you have 0% interest rate, that equates to faster payoff. It means that you can pay down your debt faster, because interest actually eats into the amount you pay down for your debt. So when there's no interest, more money goes into the principal balance of the debt. Number 2, set time pressure. You know, the human mind works in a very funny way. When you know you've been given 12 months without interest, naturally what the mind tells you is that I have to pay down this debt as fast as possible within that period of time, so that I don't get to pay that interest when the promotion period ends. That way, unconsciously, you've put time pressure in your mind. To you, I need to get this debt out of the way because it's saving me thousands of dollars without interest rate. I don't want to get to the 12 months period and start paying that high, annoying interest rate again, right? So it puts your mind under pressure to pay that debt faster within the time frame. And that's what set time pressure means. 3, it simplifies the way you consolidate your debt, right? So when you have multiple debts on multiple credit cards, for example, right? Credit card A has $5,000, credit card B has $10,000, credit card C has $5,000, right? That's $20,000 in total. You can consolidate those debts to the new balance transfer credit card, assuming the credit card has the limit to absorb all those debts, and you have one payment without interest rate. So in this case, the $20,000 goes into the balance transfer card with a $20,000 limit, and you can pay one payment without interest rate. How cool is that? You get to save so much interest on 3 different cards, thereby simplifying your own debt. With every good product, there are things you need to watch out for, and I'm going to list out some of the things you need to watch out for so you can make your decision with enough knowledge and information as possible. One is the transfer fees. What the banks normally do, or what the lenders normally do, or anybody that offers you the balance transfer card normally does, is to say, if you transfer a certain amount to me, I will charge you a transfer fee. From my experience, the transfer fees have ranged between 2% and 4%, right? So for example, if you're to transfer $10,000 at 2%, they would charge you $200, which is 2% of $10,000. And I know for sure that the reward outweighs the risk regardless of the transfer fees, because typically on a $10,000 credit card balance with a 20% interest rate, you would pay $2,000 in 12 months, $2,000 per year. The second thing you should keep in mind is the credit score impact. If you have to apply for a balance transfer credit card, it's the same thing as applying for a credit card, and applying for a credit card gets a ding on your credit score. It's called a hard inquiry, right? So if any lender goes and inquire about your credit profile because they want to offer you a credit card or a debt product or a line of credit, you get a ding on the credit score, which means your credit score takes a ding, sometimes 5 points, sometimes 6 points, right? If you do the math and you see that an approval of this balance transfer card will save you thousands and thousands of dollars, and you have to get just 5-point ding on your credit score, you have a good credit score of 800, you get dinged 5 points, it becomes 795. But then again, you have to save, or you will save $2,000 or $3,000. Well, that's a good thing, right? Right? The credit score can take a little ding for you to get that amount of savings. Like I've mentioned before, one of the concerns is that the high interest period will resume when the promo ends. So if the bank offers you a balance transfer promotional offer for 12 months, when the 12 months elapse, the high interest rate of that credit card kicks back in. So that's why you set time pressure on yourself to pay out the debt or the balance as much as possible within the period of the promotional offer. Lastly is the missed payment. One of the catch there for balance transfer promotional offers is that you do not have a missed payment, right? What that means is that when you get that offer and you miss one payment, the credit card reverts back to the old interest rates. And I think this actually keeps you more disciplined, right? You don't have to miss payment regardless of the product you're being offered. But if you get offered this product, it puts you in a more disciplined way to say, I don't want to miss this payment because I don't want to revert back to the old or high interest rate, at least for the next 12 months, 10 months, or 18 months. So let's look at a typical example, right? Let's say we have a supervisor called John. And by the way, this is a true life story. I spoke with some of my friends, and one of them had this issue, right? But let's say, let's call him John. It's always John. It's always going to be John, right? So let's call him John. John owes $10,000 in his credit card. And John got an offer from a certain bank in North America, in Canada, in the United States, to transfer those debts, those balances to a new credit card called the balance transfer credit card with a 0% interest rate. John gets very excited. The catch there is that they will charge him 2% of the balance. So that means when John transfers the balance, the 10,000 balance from his old credit card to the balance transfer credit card that the bank has offered him, he pays a transfer fee of $200, which is 2% of the $10,000 balance. What John needs to know is that for the next 12 months, he pays 0% on that 10,000 balance. Now remember, the original interest rate of that credit card is 20%, right? Which means if John leaves his balance entirely for 1 year, he would incur an interest cost, an interest payment of $2,000, which is 20% of $10,000. However, with a new balance transfer, he only paid $200 in fees and 0% for the next 12 months, which is good because John has saved $1,800, which is $2,000 that he would have paid if he left his balance on the old credit card, minus $200 he paid for moving to the new balance transfer card, leaving him with $1,800 in his pocket to do so many things. Now, he could decide to invest that money somewhere. He could decide to pay down the balance of the card faster. Remember, he has 12 months to enjoy the 0% interest rate. So if he pays down the balance faster with the additional funds he's getting by saving $1,800, it drives the balance down. And when it drives the balance down, the interest portion of any debt goes down when your principal balance goes down. And that's it. John have saved $1,800 in this example. And imagine if your balance was higher than that, you get to save more. So I think this is a very good product that the banks have used to compete with each other to win your business over. But more importantly, it keeps money in your pockets. So if you're short on cash, I truly think balance transfer is a straightforward and practical way for you to save on interest and pay down your debts. I am building a community where everyone literally uses simple and actionable items to pay down their debt faster, grow and build their wealth, as well as invest in the right way. If you like this video and you've learned something good, please share this video so we can build a wider community. Do not forget to subscribe, like, and follow me on my social media platforms. Until I meet you again, until my next video, stay safe and stay blessed. Bye guys.